What's up, guys? December 3rd. I came across this article. I thought it was pretty funny. I want to share it with you guys. The title is JPMorgan has some bad news for Bitcoin bears. The reason why I found this article is so extremely funny is because there was a lot of news around JPMorgan saying that Bitcoin's a scam, it's a fraud, blah, blah, blah. And now how quickly they're changing their tune now that Bitcoin is over 11,000, which is incredibly funny to me. So this is a little bit of a longer article, but it's well worth the read. I'll link to it in the description below if you want to check it out, but I'm going to be going through it right now. So just over 2 months ago, JPMorgan CEO Jamie Dimon said he considered Bitcoin to be a fraud that will not end well and would fire any JPM trader trading it. The very next day, one of JPM's most respected analysts, quant wizard Marko Kolanovic, wrote a lengthy report to substantiate his boss's anger and skepticism, concluding that cryptocurrencies are most likely pyramid schemes and that the future for cryptocurrencies will likely not be bright. Predictably, since then, the price of Bitcoin has tripled, ensuring that virtually all retail and most institutional investors are far more interested in trading highly volatile Bitcoin, Ethereum, and other cryptos and stocks, and JP Morgan has been dragged kicking and screaming into reversing its position on cryptos. And at the end of November, the Wall Street Journal reported that the bank was willing to help clients trade Bitcoin for a hefty fee, of course, even as the bank CEO explicitly called the digital currency a fraud, effectively violating its fiduciary obligation. And now, with just 2 weeks until December 18th, when Bitcoin futures will now start trading on the CME and CBOE, JP Morgan's reversal has gone so far as prompting one of the bank's top strategists, flows and liquidity author Nicholas Panagarinujubujus, that's definitely not his last name, to predict that the introduction of Bitcoin futures has the potential to elevate cryptocurrencies into an emerging asset class, which sounds quite different from Bitcoin is a fraud. Very, very different indeed. The emergence of cryptocurrencies, his thesis is simple. The more widely accepted Bitcoin becomes and the more widely traded, especially on regulated trading platforms, the greater the cryptocurrency's credibility, making it more appealing to both institutional and retail investors. With Bitcoin reaching 10,000 mark this week, partly fueled by the prospective launch of Bitcoin futures contracts by established exchanges such as the CME and CBOE, the question that arises is about whether the new asset class is emerging, potentially competing with other more traditional asset classes. The prospective launch of Bitcoin futures contracts by established exchanges, in particular, has the potential to add legitimacy and thus increase the appeal of the cryptocurrency market to both retail and institutional investors. In slamming his boss's skepticism, the JPM strategist also writes that the perceived value of Bitcoin would rise over time if more people use Bitcoin and other cryptos as a store of wealth and more merchants accept it by means of payment in exchange for goods or services. He goes as far to suggest that crypto may be a better architecture than fiat. One could even argue that the soundness of the technology on which Bitcoin or other cryptos run makes them even more attractive as a means of payment. We hope Jamie Dimon is paying attention here. Cryptocurrencies are easily transferred and are not easily counterfeited because of blockchain, which serves as the public ledger for all transactions without the need of a central server, avoids the risk of double spending. But wait, more praise from JPM is forthcoming. The Flows and Liquidity Report lists numerous other reasons why the price of crypto has the potential to grow further from here, along which the total market cap for the cryptocurrency market has exceeded $300 billion for the first time this week. In particular, data from CoinMarketCap shows that the market cap for all crypto stands currently roughly at $302 billion, with Bitcoin's market cap accounting for more than half at about $168 billion as of November 30th. Ethereum, the second largest crypto, has market cap of $42 billion, followed by Bitcoin Cash at $23 billion. This rapid rise in the market cap of crypto market, which has tripled in terms of AUM since June, is at first glance making it comparable to other competing asset classes, such as gold. In fact, the rise of the market cap above $300 billion means that the AUM of cryptocurrency market greatly exceeds the total size of gold ETFs at $90 billion. Does this mean cryptos have grown in size well beyond competing asset classes such as gold? No, not necessarily. First, gold ETFs is not the main way wealth is stored via gold. Wealth is mostly stored via gold bars and coins, the stock of which, excluding those held by central banks, amounts to 38,000 tons. In other words, the market cap of cryptos would have to rise 5 times from here to match the total private sector investment to gold via ETFs or bars or coins. Second, in theory, the market value of cryptos could eventually rise beyond what could be justified by only valuing them as a store of wealth. As mentioned above, cryptos derive value not only because they serve as a store of wealth, but also due to their utility as means of payment. The more economic agents accept cryptos as a means of payment, the higher their utility and value. Naturally, one way to gauge public adoption and interest is thus future price appreciation is by observing daily trading volumes. How much money changes hands every day in cryptos versus competing assets classes such as gold. According to the publicly available data, monthly volumes of Bitcoin traded has sharply increased in dollar terms around 140 billion in November, while volumes of Ethereum, the second largest crypto in terms of market cap, rose to around 30 billion. The surge in Bitcoin volumes was largely a function of price appreciation. However, in terms of units of the respective cryptos, the increase simply brought trading volumes of Bitcoin back to levels seen since May, while trading volumes of Ethereum were some way below their peaks earlier this year. And they have two charts comparing Bitcoin and Ethereum. By comparison, JPMorgan notes that monthly trading volumes in gold futures have averaged nearly 900 billion in recent months, while gold ETF volumes have averaged around 30 billion. This means that trading volumes in the two largest cryptos would also need to rise by more than 5 times to match the volumes of gold traded on via futures and ETFs. That said, JPMorgan correctly predicts that Bitcoin trading volumes will most likely increase further once futures contracts are introduced on Bitcoin in the coming weeks, especially once those eager to short Bitcoin finally have an instrument that allows them to do so. Then again, the potential shorts may want to reevaluate if for only one key reason. While all above has been covered in zero hedge previously, this is hardly news. The JPM report revealed one particular piece of very bad news for Bitcoin shorts. Consider that as of this moment, the market cap of all cryptos is 330 billion, a respectable number. If well below the total value of wealth stored via gold bars and coins, the stocks of which, excluding those held by central banks, amounts to 38 tons, as noted above. What is striking, however, is not how large the market cap is for an asset which so many say has no intrinsic value or is a bubble, but how it got there. Because due to the unique features of Bitcoin, which still remains a relatively illiquid asset, while its market cap may be 186 billion or just over half of that of the total crypto space, what is stunning is how it got there. Now, this is the interesting part of this article, right? As JPMorgan explains, high trading volumes or market caps does not mean that the net flow directed into cryptos has been equally big. Here's the bank's punchline. The net flow into cryptocurrencies is very much a function of coin creation, which is controlled by computer algorithms, and in the case of Bitcoin, is diminishing over time. Figure 6 shows the net amount of money invested every year since 2009. The cumulative amount has totaled around 6 billion since 2009, well below the current market cap of 300 billion. For Ethereum, the number is just as stark. With a market cap of 45 billion, net inflows have been under 2 billion in the past 2 years. This is shown in the chart below. Right? So like I said, guys, this is the interesting part, and this article is almost done. So if JPMorgan is right, the implications are staggering. Contrary to expectations that Bitcoin's market cap is a rough reflection of its inflows, JPMorgan's calculation reveal that a mere 6 billion in net inflows since 2009 has resulted in a market cap of 330 billion. This goes to what Mike Novogratz said last week when he said that cryptos are unique because unlike all other asset classes, there is no corresponding increase in supply when prices surge. This also means that as new capital flows into crypto space, as more retail and institutional investors scramble for a piece of the pie, the potential market cap gains are unprecedented. Putting this number into context, so far in 2017, there has been 283 billion in global equity inflows, 402 billion in ETF inflows, and 120 billion in mutual fund outflows, and 346 billion in bond inflows, as this Bank of America table reveals. If only a fraction of these institutional retail flows were redirected toward Bitcoin, then the next, an even more parabolic leg higher would be upon us, inviting even more bubble comparisons, even more skeptics, and even more converts. Just like none other than Jamie Dimon himself. In other words, shorts beware, especially now that shorting and short squeezes is about to get much easier thanks to Bitcoin futures. Like I said, guys, this is very interesting. A huge turn from what they said just a few months ago. They're basically telling bears to beware and that they would be essentially ridiculous to short something so powerful as Bitcoin. This thing is only going to get bigger, guys. If we take a look at this, the GDAX, it's just this thing is just like it seems unstoppable. There's a lot of people that are actually predicting that this week it's probably going to hit 13,000 or 15,000. We will see. It's just incredible just to see just how much volume has come into this in the past couple of days and weeks and months, and I'm really excited to see where this goes. So I hope you guys enjoyed the article. If, as always, if you like the video, just leave me a like. If you have any comments, if you want to chat about this further, leave me a comment in the description below, and we'll talk about it there. And if you want more daily content from me, make sure you subscribe, because I come out with daily videos every single day. So thanks guys for watching and tuning in. I hope you enjoyed the article, and I will see you in tomorrow's video.